Welcome to SB Talks. Today is Tuesday, April 8th, and I am joined, as ever, by our Chief Investment Officer, Nick Ryder. Welcome, Nick.
Thank you, Vinny.
Now, Nick and I will be discussing one topic and one topic only, and that is the fallout from President Trump's U.S. Liberation Day. Welcome to all our listeners. The dust is beginning to settle after the much-heralded Liberation Day, and the U.S. market's now down over 10% since the announcement of the reciprocal tariffs. It's fair to say President Trump has pretty much sent market uncertainty into overdrive.
Yes, so people are calling it the Trump dump or Trump slump. So yeah, definitely had a major impact. I think what's really caught the market by surprise is the speed, the breadth, and the magnitude of the reciprocal tariffs. And I think the other thing that's really shocked the market was just the way in which they were calculated. So it turns out that it wasn't based on the size of tariffs and non-tariff barriers that other countries impose on the United States. It was really based on the size of the structural trade deficit.
And that's a really important point because we'll talk many times over the course of this podcast. It is about the uncertainty of where to from here and just the arbitrary nature of how these reciprocal in exclamation marks tariffs were calculated has probably spiked up that uncertainty because it's sort of structurally impossible necessarily for these countries to undo the trade deficits that they have. Maybe walk us through a few examples.
Yeah, so let's take Cambodia and Vietnam at 49 and 46% respectively for reciprocal tariffs. Now, They do, in some cases, have their own tariffs on imports, so that's fair, but that's certainly not the basis on which those numbers were calculated. It was simply taking the amount of stuff that they import versus export to the United States and dividing it by 2 as a ratio. And so I think the percentage that Cambodia sends to the United States divided by the total trade, it worked out at 98%, and you divide that by 2, you get to 49. So that's how it was calculated.
That's where you get your reciprocal tariff number from, even though it's got nothing technically to do with the
that's
actual
right.
tariffs that they impose on the United States.
And they're quite a low-income country. They're not going to be importing a lot of US goods. So it's very difficult to see how they could possibly rectify that trade imbalance. So they may negotiate, and I'm sure they will try to negotiate. 50 countries apparently have approached the White House seeking to negotiate these reciprocal tariffs down. But how do you overcome something like that where there's structural issues that they'll find hard to negotiate
as you
around?
correctly point out, look at the wealth of their market, the wealth of their consumers. They're not going to be buying a lot of US exports, and therefore naturally they're going to have that trade imbalance. So it's going to be quite interesting to say, if there are deals to be done, what are the deals that they're seeking from these countries realistically?
Well, I think you have to look at it in the longer term context, and so if you think about political considerations and national security, this is really probably originally about China. So China over the last 30 years has gone from 5% of global manufacturing to 32% of global manufacturing. The US has gone from 24 to 15 over that same period. A lot of critical manufacturing for national security is no longer done in the United States. So I think it's part of a longer term plan to obviously reindustrialize the United States and bring back key manufacturing sectors to the US, and that is the long-term plan. So you need to look at it through that context. There's also the issue of Donald Trump, who since the 1980s has been complaining about trade unfairness and being ripped off by foreign countries, and so he has this sort of grievance around that and thinks that these tariffs will help solve that. And then there's Trump, the negotiator. So I think when you mix all of those things together, it's very difficult to see a lot of relief in the near term from some of these tariffs.
Yeah, so the market's got a mini reprieve in the middle of the trading session in the US last night, where there were sort of some announcements that potentially there may be a deferring or delaying of some of the tariffs, only for that to be quickly debunked as fake news by the White House. So you set out a lot of the the reasons or the rationale potentially for why President Trump believes what he believes, and some of those in his administration as well. Now, we could probably work our way through and argue counter arguments to whether that, manufacturing really would return home, whether there are the employees who want to take those jobs anymore. But if we step away from that, I guess I ask you to put your chief investment officer hat on at this time, and it is quite challenging. Because there has been a very arbitrary nature to the approach to this, and therefore that has created the degree of uncertainty that we are seeing, and the range of outcomes that we could potentially have from here are definitely broad.
Yeah, so there's you're right. There's a huge degree of uncertainty, and I think that's likely to continue for most of this year. Now, there could be negotiations, and so, for example, today Israel is meeting with the US, and they seem willing to try and come to some sort of trade arrangement.
Now, as I understand it, Israel sort of dropped their tariffs to the floor just before these announcements came, with the theory that we are not going to tariff you, therefore reciprocally we should be free from damage. But that, because of the formula you just explained, that is not how it played out for them.
No, but they do appear willing to try and at least solve the imbalance, the trade imbalance. I'm not sure how they do that. These things take time, so we'll see what comes out of that. And the US appears willing to start trade negotiations with Japan, which have been hit with, I think, 24% reciprocal tariff. So there's some glimmer of hope there, which I think is one of the reasons why the equity market, was broadly flat overnight.
Yeah, it's sold off quite significantly. So I think the Nasdaq, from its mid-February peak to where we got to by last Friday night, had sort of crossed over that sort of 20% mark. Some of the other key indices getting close to it. That's a very significant sell-off in a short period of time. It's worth probably then saying, okay, well, given the world as we knew it entering into the year, the health of the US economy, the US consumer earnings, etc., yes, we're now layering over, a changing of the international trade framework on top of that, but we really don't quite know how that's going to work out. There would be one argument, which is, okay, well, why don't you just, for example, go to cash? Go to cash while this all plays out. Who knows? We know that Trump is unpredictable, erratic at best. Therefore, the only safe place is to run to cash through this type of an environment. Give me the arguments for why we don't do that.
Yeah, because for any over any long period of time, cash is the worst performing asset. It's the lowest risk, so therefore it provides the lowest return. We're also in an environment where central banks, including the RBA, could very well cut the cash rate quite substantially. So, yes, it might be a place to hide for a short period of time. But generally, over the longer period of time, you won't achieve your investment objectives if you're invested in cash.
And then the counter argument is, we'll jump back in when the market looks good, and we know that the uncertainty is gone and the world is a sunny, settled place once again.
Well, you might be waiting quite a while for that. We've got Trump here for the next 4 years, so it's we know he thrives on uncertainty. That's his modus operandi, and so I think if you're waiting for that sign, you might be waiting a while. Now, I might say, to get back to one of your earlier questions, there's a couple of scenarios from here. One is that there's negotiation, and some of these reciprocal tariffs get negotiated down. I don't think they're going to zero. I think we're still going to see, for many countries, a 10% baseline tariff, and the tariffs on particular sectors like steel, aluminium,
they're
autos.
They're strategic. They're likely to remain.
They're likely to remain, and then there's also the possibility of additional sector tariffs on pharmaceuticals, on semiconductors, on copper, and on lumber. So I think we should expect those to remain. So there's scope for a bit of an off-ramp through negotiation.
Yeah, and let's pause on that for a second, because what might that look like? We're not saying that suddenly there's going to be deals across the board, but you have a scenario where the market gets optimistic that some deals are done, that some concessions, for want of a better word, are made, and that there's a bit of a pathway through this that begins to appear that sort of says, okay, we're not going back to where we were, but the uncertainty is at least reduced.
Yes, and that would definitely be helpful, but still negative for growth.
Albeit we entered the year with strong growth forecast. So at least that is one positive, that we didn't enter it with a very fragile economy and then layer this on top of it, because that could have been quite horrendous.
That's right. So, I mean, it's interesting. Goldman Sachs just increased their recession odds for the US from 35 to 45%.
Right.
And that's on the assumption that some of these tariffs get paused or negotiated down.
And for what time period? Is that
For this year.
Calendar year?
Yeah. But they say if they don't, then they will flip to greater than 50% chance of a recession. JP Morgan has a 60% chance of recession. So I think we have to expect a significant slowdown in US growth and in global growth, whatever happens this year, just given uncertainty and given, this very severe fiscal shock, because what we're essentially talking about here is a massive tax increase on the US consumer, the largest since 1968. It's equivalent to about 1.5% to 2% of GDP. So that will have a big impact on US consumers, even if some of these subsequently get, negotiated down. So that's sort of the one scenario. The worst scenario, though, is where, and we've seen evidence of this overnight. Escalation, doubling down. China announced 34% reciprocal tariffs on US imports. Donald Trump then responded with 50%, and so we just get this sort of, spiral.
Tit for tat game there.
And there is a possibility that something similar happens in Europe with reciprocal tariffs. We've already seen some announcements on that, but they're not as extreme as the Chinese.
Yeah, I think they're treading a little bit more carefully. But let's talk to China specifically, because it's fair to say that strategically, when the US is looking at a strategic threat economically, potentially militarily, China is really it. And this is the space where they are likely to be quite determined on their tariffs, and potentially China likewise in return. And also particularly important for Australia, because while our direct trade with the US is not necessarily huge, it is certainly, if it hits a trade, China, for example, a much more significant trading partner for Australia, then the impacts here could be much greater.
Yeah, I don't think the impacts on Australia would be huge. For example, a lot of the iron ore that we send to China is turned into steel, and 90% of that gets consumed domestically. Only 10% roughly is exported.
Yep.
So I think there's a good prospect that China will look to potentially restructure their economy. They've obviously been too heavily, investment and exports has been too big a part of their economy, and they're very keen to get the consumer.
Their internal consumer, much like the US internal consumer drives their economy.
Yeah, so they want consumer spending to improve, and also, for China, this plays into their some of their sort of geostrategic aspirations, which is, greater engagement with potentially countries in Southeast Asia and in what they call the global South. Those countries may actually fall more into the Chinese orbit as a result of some of these moves by the US.
So again, just a bit of a resetting of the potential trade relations is very likely to play out, not just for the US, but then as other parts of the world find different markets, in the EU, again, potentially looking to where their most stable trading partners may lie.
Yeah, well, the EU is looking to potentially join the Trans-Pacific Partnership, which is the sort of the free trade group in the Pacific that Australia is part of. So, yeah, there will be a reordering of trade flows, and potentially we also benefit, that some of those products that might have gone to the US will come to Australia, and maybe that helps bring down inflation. So there's implications there. But I think what we'll see is China will stimulate its economy with fiscal stimulus. It can cut rates, and the same in Europe.
Yeah,
although there will be pain. But both of those economies will try and become more self-sufficient. Will try and find other markets for their products, join other free trade regions. So I think there's It's not all doom and gloom.
Yeah, I think you're sort of sketching out a middle path here as I listen to it to say, well, perhaps the full extreme or extent of what we saw announced last week might not play out in glorious technicolor, but it's also not going to be zero. So we have to reckon and ready ourselves for the fact that we're going to potentially see some concessions in some places, but we are seeing a bit of a reordering of things. And that's not all doom and gloom. That can mean that other things will play out, but it will take time and markets will resettle and restructure.
That's right. And the US, having potentially raising up to $1 trillion, but probably more likely 500 billion from these tariffs if they all stick, depending on how much people cut back their spending on some of these things. A big
point, are the consumers just going to wear the prices? And obviously there's this whole debate about who pays, producer versus consumer, but if the consumers drop back their spending, then you certainly don't get the projected tax take from tariffs that you otherwise thought you would.
Yeah, but the Congress might choose to take some of that additional revenue and to plough it back into tax cuts for, no taxes on tips and on overtime, which potentially offsets some of the impact on the consumer from some of these tariffs. So we just have to keep an eye on that.
And let's talk about, when we were talking about potential stimulation, let's talk about the Fed. Jerome Powell, very careful in his wording and anything he's been saying in recent times, because they are processing just a rapidly evolving situation in front of them.
Yeah, so markets have moved to price in 4 rate cuts from the Fed this year, which probably looks a bit aggressive. I think the Fed's in a very difficult position that they are monitoring inflation expectations. So the University of Michigan will be releasing their latest numbers later in the week. And currently, I think the latest report had people believing inflation would be about 5% in the year ahead. So people are starting to bake in
the US.
In the US.
So obviously that's factoring in some of the short-term tariff impacts of those prices filtering through. So naturally you would expect that.
Yeah. And so the Fed, they know, or they've said that tariffs would probably be temporary, but what happens is people start to bake it into their expectations and then go and ask their boss for a bigger pay rise. It just becomes this sort of price wage spiral that we saw a little bit a couple of years ago. So the Fed will then not be in a position to necessarily respond to slowing growth and rising unemployment. So they're in a very difficult position, and I think they're more likely to be reactive than proactive. They'll look at data as it comes out and then make the decision. Otherwise, they really will sit on their hands.
And in fairness, it's very hard to be proactive when you're looking at such a broad range of outcomes and such a rapidly evolving picture in front of you. The positive is that they made the rate increases that they did over recent years and at least have that ammunition to use if it comes to that.
Yeah, they do. And on the US unemployment picture, I think there's a few dynamics going on. So yes, while companies will be uncertain, they'll probably scale back their investment plans and their hiring plans, and we'll probably see employment growth slow. There's no immigration at the moment. So the labour force is not expanding. So the supply of workers is actually sort of slowed quite dramatically. So we mightn't actually, even though the number of jobs being created might slow quite a lot, last week we got 228,000 for March, which was quite a strong number. That could slow down to 100,000 a month.
But if the supply is correspondingly decreased.
That's right. So the unemployment rate mightn't go up that much.
Which, again, begs the question, if you were to start to rehouse some of this manufacturing and other things onshore, are the employees even there? Who wants to do those jobs?
Yeah, well, I could talk about jobs for US robots.
That's very true.
Yeah.
So I'll ask you to put your Chief Investment Officer hat on once again, and let's talk about how you build portfolios for times like this. Now, I don't mean specifically because Nick predicted that we were going to see these ridiculous reciprocal tariff calculations. Unfortunately, there will always be uncertainties in the world. But how do you build portfolios for uncertainty? What diversification do we have in there that counterbalances exposures to things like Australian or US equities? And why their sensible path is to stay the course with that diversified portfolio rather than, as I sort of somewhat in jest said before, we all just go to cash and wait out till the uncertainty has passed, which it never truly has.
Yeah, so in most of our diversified portfolios, we have 8 asset classes. 2 of those are Australian equities and global equities, and they can be, in some cases, the biggest drivers of returns, or certainly short-term returns. But we have the other asset classes. So we have cash, and we have Australian government bonds and global government and corporate bonds. And we've seen bond yields come down quite a lot. So as bond yields come down, bond prices rise. So you get an offset from bonds, particularly government bonds, in a scenario like the one we've been in the last few weeks. We also have a heavy allocation to defensive and growth alternatives.
Talk more a little bit about what that means at a high level.
Yeah, so broadly, it includes things like hedge funds, which are market neutral, which should hopefully be able to make money or at least not lose money in markets like what we've seen. And from speaking to a lot of the managers that we use, they've actually done reasonably well over the last few weeks. And then the other thing that we have in portfolios is unhedged currency. So our global equities is unhedged, completely unhedged. And we've seen the Aussie dollar fall from sort of 63 down to below 60 over the last few days. So that's helped buffer.
A little bit of a parachute on the way down.
Yeah.
And that's deliberately why you construct the portfolio that way, to give you that buffer.
That's right, because the Australian dollar is very sensitive to global growth outlook and to what's going on in China and to risk sentiment more broadly. So it is a good shock absorber in portfolios.
And not always, but on many occasions, also potential adoption of certain private market exposures within the portfolios. Again, different pricing methodology, not revalued on a daily basis with the full swings in sentiment. So taking, I guess, some of that edge off in terms of the portfolio moves.
Yeah, certainly the short-term moves. I mean, longer term, if there's a global recession, those asset classes will be impacted.
Will be adjusted.
Yeah. And I think the other thing is just to remind people that we do have a big chunk in Australian equities. Now, obviously, if the US sells off, our market tends to sell off, but the US market, the S&P 500's down 17% since its peak. Our market's down about 12.5%. So it's fallen, but it's given, we've got more banks and miners and companies like that may be less sensitive to global trade than, potentially there's some global or geographic diversification there.
And there's reasons that you don't have portfolios that are 100% S&P 500 or 100% NASDAQ, where as much as that might have been a wonderful place to be in sort of 2024 or 2023, you have to build a portfolio for days like this. And then I guess as a client, it's about making sure that your risk profile, your asset allocation matches to your risk profile, and then we stay the course.
Yeah.
It doesn't mean that we don't make any changes. We make adjustments as appropriate as the situation unfolds in front of us, but we certainly want to avoid the rash need for action in reaction, because we've built portfolios to withstand days like this.
Yeah, absolutely. There's always shocks like COVID, like the global financial crisis, like Ukraine. So we can never predict them. Although I would say that in our 2025 investment outlook that we wrote in December, we did highlight the risk of a potential major trade war. Although it wasn't our base case, it was definitely in our thinking. And I guess, like everyone, we were surprised at the speed, extent, and breadth of the tariffs on Liberation Day.
That's why we hold bonds. That's why we hold alternatives in portfolios. They are there to help protect us at times like this. And, we don't rule out that there's an opportunity to potentially put more into equities at some point.
Well, absolutely. If the market overreacts, although I would say there's probably, if there is a recession, equities typically sort of trade down to multiples of sort of 13, 14, and we're at 18. So there's still a fair bit more downside.
If you were heading, and again, recession, it probably depends whether you have a mild recession or a deeper recession. A mild recession, sort of an economy and equities can move through quite quickly, but a deeper one that takes a number of years to recover from. Hard to think that is what the US administration wants, but we do not aim to second guess what they're going to do, to be honest. We manage our way through it as prudently as we can. Wonderful insights as always. Thank you very much, Nick. And thank you to all our listeners.